More Americans filed jobless benefit claims than was anticipated last week. So should we be bracing for tomorrow's unemployment data? We're joined now by one of the most accurate labor economists ranked by Bloomberg for his outlooks on the jobs front. He's Guy Lebas, chief economist and fixed income strategist at Jansey Montgomery Scott. Good morning to you, Guy. Should we be bracing ourselves for Friday morning's data?
Well, there's certainly a little bit of reason to be concerned, but really we believe it has more to do with seasonal adjustment factors that are put out by the Labor Department rather than actual increased lost jobs. Since the manufacturing industry has been so volatile with the bankruptcies of major auto companies recently, the sort of traditional seasonal manufacturing job changes have been a little bit skewed.
Well, today we heard, 200 jobs, a smaller number than you might expect to make headlines at Office Max. But then we heard earlier this week, Danaher cutting more than 3,000 workers. So that seems to be something more than seasonal if we're still seeing corporations come out and reduce payrolls.
Well, really what we're seeing in the bigger picture, taking a step away from individual corporations, is that the sort of liquidity-driven job declines, the idea that a corporation couldn't make payroll because they couldn't borrow, those are now behind us. And what we're really facing is sort of profitability, longer-term, fundamental-based job declines. And that pace is going to be a lot slower than it was even a couple months ago.
Okay, so it's really up to making earnings targets then, if it's just about sort of increasing profits and it's not about inability to cut a paycheck.
Absolutely. At the end of the day, profitable companies are the ones that hire workers. And we're going to need some return in corporate profitability before that trend of hiring more workers and supporting consumer balance sheets really starts in earnest.
So what we're seeing, productivity rise, well, the number of jobs is dropping. So that doesn't really augur well in terms of growth and rehiring of the unemployed.
No, not really. And really the increase in productivity that we have seen, we saw data from the second quarter out yesterday, that increase in productivity was sort of employers cracking the whip, if you will, on those employees that do remain. So capacity is very spare right now. We have a lot of excess capacity in the system, and there's no need to really hire at the moment, but that will come down the pike.
I'm looking at your forecast now, and you're saying the bodies are still yet to be counted here. 100,000 jobs will be lost each month through 2010. You don't expect growth until the second quarter of 2010.
Absolutely, and that comes down to that same concept about profitable companies. Economic fundamentals, and particularly consumer activity, remains weak. So there are a lot of corporations, particularly retailers out there, that's going to take some while before they return to profit and they return to hiring ultimately.
Where are we going to see the hiring? Michael McKee, our economics editor, was just with us saying, oh, look, the Midwest is actually a bright spot. Maybe that's part of the seasonal trend you were talking about there. But where are we seeing patches of improvement, if at all?
Well, we are seeing patches of improvement fundamentally in the manufacturing sector. We have a lot of job losses in that sector, and it traditionally tends to lead economic recovery. So we're looking for that sector to sort of stabilize first and then start to provide the gains into 2010.
If you look at the bigger picture right now, beyond just the jobs front, but productivity, that ISM non-manufacturing number we got today, how does this sort of set the table for the Federal Reserve and its plans to continue buying securities? Do you see that plan ending anytime soon?
We're actually not looking for the Fed to extend its plan significantly, nor are we looking them to reduce it. So we believe the Fed is going to maintain their original commitment, in large part just in an effort to sort of maintain true to the markets, to deliver what they promised on.
Now, today, back-to-school numbers, we're finally getting them. Obviously, how much the consumer can spend or feels like they can spend is very much influenced by whether or not they have a job. But it gets us back to that fundamental question of, can you have an economic recovery without the consumer fully participating here? I mean, consumer spending makes up 2/3 of the economic activity in this country. Is the model going to change, or are consumers going to have to come back for recovery to happen?
Well, what we believe is that the start to a recovery really has to begin on the corporate spending, investment, and housing market side. And that start is really already underway, but in order for the recovery to have legs, if you will, we're going to need the participation of, as you referenced, the last 2/3 of the economy. And that participation, the problem is not likely to hit until really the very end of 2009 into the very beginning of 2010. So right now we're supported by corporations. Later we'll be supported by consumers.
To paraphrase you, if I could have that liberty, by cutting jobs, stores are actually cutting their own legs out from under them in terms of continuing to boost sales, it would seem. Anyway, Guy Lebas, Jansey Montgomery Scott, thank you so much for your analysis this morning.